Welcome back to the lecture series. Today's lecture series, we're going to have two distinguished angel investors. It just seems that that in the investing category, and particularly with the types of ventures and the stage of ventures that people are working on in this environment, that knowing a bit more about what angels do, who they are, how the whole system works, and how to go through that process, and even some of the more complex parts of the deals and terms that get done, just seems much more relevant. And so on that account, we've tried to bring in some angel investors. And so I'm going to introduce them now, and we're going to have a bit of a conversation, and then we'll open it up to Q&A afterwards. So let me start with our first guest, who's Bill Payne. He is an entrepreneur, but he is also an experienced angel investor, along with being a senior program consultant for the Kauffman Foundation. He's currently on the board of the Vegas Valley Angels, so we should appreciate that he came here all the way from Las Vegas to speak to us all here. He's been previously active in a number of angel groups. I won't list them all. He's been part of 39 different investments, and it turns out that if you add up all of the board experience that he has, it adds up to 120 years of being on boards, which is a lot, actually. And that's on both private boards as well as nonprofit boards. So Bill Payne, please join us. And next, we have also an experienced entrepreneur and angel investor, Ian Sobieski. Ian is the founder of the Band of Angels and currently the managing director. And this is a $50 million venture fund that was raised in 1999. Ian was with this group since 1997. He was an executive and director of the company Evite previously. That is before the band. And he's been in 40 direct investments that have totaled $30 million. And he is, because he's younger, he's only on 14 boards up till now. So Ian, please come on up. So what we have here is we've got a list of questions which we'll seed this conversation off with. And
I wrote them, so that'll help. I think I may know the answers.
And he thinks he wrote them because they were changed since then. and so let's start off. So we've done a bit of intro, and now this is basically moderated Q&A, and then we'll open it up to questions broadly. So just starting with, could you guys both tell us actually a little bit of background on the organizations that you're part of, and to the extent that you would differentiate that from normal venture firms or other sources of where money comes from for new ventures?
Want to start, Ian?
You want to?
No, you want guys.
Okay. 15 years ago, angel investing was an individual sport. That means that wealthy, accredited investors went to meetings with no title on their name badge, but were looking around for possible opportunities to invest in companies. So it was really difficult for entrepreneurs to find them. About 1994 or so, there were probably 10 or so angel groups in this country, and now there are roughly 275. And the Band of Angels, Ian and the late Hans Severns, started the band and were one of the first groups that began in this country investing as groups in deals. And the big difference for entrepreneurs is it's very easy to find us. Go to the web and look for angel groups or Vegas Angels or Band of Angels or whatever, and you will easily find angel groups in your neighborhood. Plus, there are directories of them in several places on the web. I helped start 4 angel groups since 1997 because I can't keep a job and can't stick in one place, so I end up helping new groups form new organizations where I happen to be spending my time. I helped start 2 angel groups in San Diego, and then I moved to Las Vegas and started the Vegas Valley Angels with 8 other guys in 2003, and then I started spending my summers in Montana, so I helped start a group up there in 2005. So I'm pretty active in angel investing.
Yeah, that's an understatement. Bill is back in the Middle Ages, they had jongleurs that went from town to town to sing epic songs, and Bill is the equivalent in the angel community. He teaches a thing called PAI, Power of Angel Investing, around the country and world, I take it, or at least the country for sure. And as a result, he may have only explicitly started 4 directly, but he's responsible for starting many more around the entire country. This is indeed part of a trend of formalizing angel investing, which is relatively recent. Hans is the one who started the Band of Angels. I joined 3 years after he started it, but he started what really was the first and now is the oldest organized group of angel investors. And it started here in Silicon Valley because this is the crucible of innovation in the United States. But it really has taken off. There are now more than 200 angel groups around the country. There's a trade association of angel groups. And it still is only the beginning of that trend. The whole financial food chain in the United States has been evolving over the course of the whole history of the country. Venture capital was once the new kid on the block, and I think Bill and I are in agreement that angel capital and the emergence of angel groups is really just the natural evolution of that food chain. And the advent of those groups allows seed capital to be deployed in a more systematic, professional, branded way into the seed stage. But this is not, and I want to end by just saying, not to take away from the fact that angel investing itself has existed long before angel groups and long before angel capital, before venture capital. And it's worth noting that innovation itself preceded venture capital. So it's really the entrepreneurs who are the focus of entrepreneurial activity, and everything else is somewhat ancillary.
All right. So let me actually follow up with a comment that you're making, which is that it's easy to go to the web and find angel groups, and I assume that there's ways to submit through the website or whatever to all of these groups. But could you basically answer a couple related questions? One is that the best path? That is it better to go to individual members and then to get brought in to the network? Or is it better to actually submit through the front door? And let me actually finish this question so you can answer it kind of all at once. So one is kind of just how do people submit? And that's what that whole question is about. And the follow-on to that is, from your point of view, how many deals do you get? How many deals do you see? How many do you get? How much is invested? Just give us some metrics as well.
Okay, well, for the band, we're privileged because we're in Silicon Valley, so their deal flow is, there's an excess amount of deal flow. So the band receives about 100 proposals per month. About 60 of those are really qualified. By that, I mean they fit what we look for. They're seed stage, they're sub $5 million valuation, they're located in the Bay Area. Those we get about 60 a month. Every deal we get comes through the website, and that is that, well, every deal submits through the website, and every deal gets looked at by at least 6 members of the band. So we have a system of farming out the material that's submitted so that every proposal is looked at by 6 pairs of eyes and graded. And then at some time in the month, I get that list of the top 60 deals and their grades, and the staff and all looks at the top 10, and we pick the top 20 or so, and we pick the top 10 to come into an in-person meeting, which we hold every month. And then that in-person meeting, everyone gets about 15 minutes for a quick Q&A, and that's it. And then we pick the top 3, and that comes to our monthly band dinner. We had it yesterday, in fact, at the Los Altos Country Club, where the whole band gets together. 3 companies get 20 minutes each to pitch, and on that basis, people then take it to the next step. So if there's no interest, the deal stops. If there's continuing interest, then we'll have a set of follow-up meetings. In terms of the best way to get into the process, referrals are always the best way of getting into any process. So if you know someone, for sure that helps. But even a referred deal has to go through the same review process I just described. And what I want to underscore is that this is one of the great competitive advantages of angel groups versus VCs. Both have pros and cons, but there is no way that you as an entrepreneur will get as fair an examination of your business plan as you would get at the Band of Angels through this process, because you're for sure going to get looked at by 6 people, whereas at a VC, if you came in cold, you'd be lucky to even get 30 seconds of attention of an associate, a single person.
You ask most VCs, how many deals have you invested in your career that came over the transom, and they'll scratch their head and may not be able to remember one. But in the case of angel groups, sure, it always is helpful to know somebody. In fact, I think maybe 10 years ago, the band looked at deals much more frequently that were referred to them rather than the kinds that you look at today over the transom. But most angel groups, you're dealing with a deal flow that comes in over the transom. So you don't need an invitation. Sure, it helps, but you don't need an invitation to apply to and get funded by most angel groups in this country. Now, we out in the hinterlands, whether it's Peoria, Illinois, or Las Vegas, or the Whitefish, Montana, we see fewer deals per year than the band sees per month. And we invest, though, probably at about the same rate they would do. I would say that we probably invest in less than 5% of the deals that come in over the transom, probably in the range of 2 to 5% of the deals that we receive. And I think that's actually not wildly different than the kind of ratio that you might see for most VC firms.
How much goes into each deal?
You mean money?
Yeah.
The average round of investment in this country for angel groups is a little over $300,000. But the range starts as low as $150,000 and goes up to a couple million. So, but when you add them all up at the end of the year, we're talking about most of them are $300,000 to $500,000.
Okay, and that's what you're seeing too?
Oh, well, that's true, but I would like to underscore Bill's question is, you mean money? Because the key thing is that money is actually much more easier to come by than intellectual capital. And what you really get from an angel group is a sort of organized way to tap a larger network. That means, in the band's case, every deal gets a band member on the board. That can be of critical importance. Our membership, to be a band member, you have to have been an operational person. You have to have either started or run a high-tech company. So these are people who walked the walk of the entrepreneur. They're much more valuable even than the $50K they might invest. But even more so, the angel groups is a place to go to just ask the question, well, is there anyone in your network who knows someone who's the VP of sales at any of these 10 companies, Cisco, Intel, Apple? And that can be an invaluable service. But the numbers are, the band did 13 deals last year. The average deal size, I think, was $400-ish thousand. The average pre-money valuation was $2.4 million.
I think a question that a lot of people would have about this whole category is what makes an angel investment deal somehow different than a venture capital deal? Maybe a different way to say that is, what is something you would invest in that you don't think a venture capitalist would invest in?
Well, in my opinion, venture capitalists and angel investors are not competitors. It's a sequence thing. We angels tend to invest in very early stage ventures, and venture capitalists tend to invest in later stage ventures. So if you need $10 million and you've got revenues and you're close to break even and you're in a marketplace where you've got an opportunity to build a $500 million company in revenues in the next 5 or 6 years, then you're probably going to be going after venture capital. If you're looking for $500,000, you're probably not going to find it from VCs, so you're going to be looking to angel investors. So we tend to invest in companies at the startup or early stage that they probably don't have revenues, but they've probably identified some customers and shown some prototypes to those customers. So we angels want to know if the dogs will eat the dog food. So we want to know, okay, who will your customers be? Have they seen a prototype? Would they buy it at this price? Is there a real competitive advantage for this product?
Oh, let's see. My answer to that would be that there are really three kinds of companies that angels invest in and VCs do, where we intersect. One is the kind of company a VC just won't touch. And that's something that, let's say, has a very small market, and the best you can hope for is either that it becomes a small cash flow positive business that dividends out income to its investors, or at best might exit at $15, $20 million. VCs tend not to touch those deals. It doesn't work for the dollars deployed versus the multiple return requirements they have. So angels do tend to do those deals because you can make 10x on a deal like that. You invest at $2 million pre, it exits at $25 million, you've made 10x. Great angel deal, as long as it doesn't need any more capital than you put in. The second category is one where the VC will do it, but it's too early for them. You have an online blog aggregator like Yardbarker, which we invested in here, that came out of Cal. Out of Haas.
Do you know that they spoke here earlier?
Great, yeah. Well, we invested in Yardbarker, and Yardbarker was too early for the VCs because it was just an idea. It was, hey, we want to aggregate sports enthusiast blogs. And the VCs say, that's a great idea. Come back when you have 1 million unique subscribers. And we're almost there. So we invest before the VC does, but it's the same kind of deal. It's just too early for the VCs. They don't want to take the risk.
Right.
The risk getting. And the third category is one where we do compete. I agree with Bill. We are generally not competitors with VCs, but if you want to read a case where we are, that worked out well. Harvard Business School just did a case on a company called Therative that the band offered a term sheet and Foundation Capital offered a term sheet for the Series A. And I was happy that the company chose us, and then the Foundation Capital came hat in hand and asked to join our term sheet, which was very nice. And a role reversal. Usually it actually happens the other way, unfortunately. But that's a case where we did compete over the same deal. We both saw the same thing, and we just offered different term sheets.
All right, okay. Okay, so basically the answer is too small, too early, but sometimes you actually do the same deals, right? That's basically what you're saying. Is there such a thing as what's hot or what's not in this from an angel perspective? In other words, are you seeing certain types of investments, for either real estate or software or something else, more commonly invested in these days, and other things that, for whatever structural reason, you just can't seem to invest in?
Dan, go ahead.
Let's see. I would say that that's true for the band, but if you're asking about just the band and angel groups, then yeah, we succumb to the same fads as everyone else. Things get hot and then they get not. So web deals were out of fashion in 2002. They're back in fashion now. We've done more web deals recently than we did then. I'll only say that with a membership of 120 people, you have all kinds of personalities, including contrarians. So. And that's helpful. In 1998, at the height of the last .com boom, we did 2 biotech companies, Cepheid and Genetope. Both went public subsequently. Cepheid just knocked the cover off the ball last week as a public company, and Genetope is about to have their phase 3 results released. So to do biotech companies in the midst of the .com craze was kind of nutty, but that kind of diversification actually helps out. But everyone's human beings, so they definitely track the fads. And I would say, whereas at the band we don't do real estate deals, there are plenty of angels and angel groups that do real estate deals, and pretty much everything else that I've seen.
I think that you have to understand the distribution of venture capital and the distribution of angel groups to have a good inkling as to how important hot is. Hot really means that generally there's a lot of activity in the venture capital community, and there aren't any VCs in Sioux Falls, South Dakota, but there are 2 or 3 angel groups in that area. So they're looking for deals where they can make a difference. Remember that, as Ian said earlier, and what's really important is that angels invest time and money in these companies, and many entrepreneurs come back to us later and say the time was more valuable than the money. So we're going to be engaged in the company. And so if a proposal is passive, like most real estate deals or oil and gas or things like that, then it's not likely that most angel groups are going to be interested in, at least for the angel fraction of their portfolio, investing in these kinds of deals. But anything where our vertical expertise, and in my case it's, hundreds of years, just because of my age, where our vertical experience can make a difference, and we can be actively engaged as directors, coaches, or mentors, but not day-to-day employees. Those are the kinds of deals that most angels throughout the country tend to be interested in.
All right. Tell me about terms. So for $300,000, which is your typical deal, what does the entrepreneur give up?
Sure. Most angel deals are done at a pre-money valuation of $1 to $3 million. So if you do the math, it's probably $300,000 or $400,000 is going to buy you 20 to 40% of the company, and that's typical of the kinds of deals that angels would be involved in. Yeah, we do deals where we get 10% of the action and where we get even more than 40%, but most of the deals are done in 20 to 40%. And when you consider the amount of risk involved in a pre-revenue company, that's a fair exchange.
Yeah, that's about the right percentage. At the band, we, on average, as I said, we do about in the $400,000. It's usually part of a $1 million round at a valuation of 2.4 was the average last year. So we're talking about a third of the company, 25% to 33% of the company in terms of a capitalization. But the whole notion of valuation is one that I wish we could find a different nomenclature for, since I find it to be misleading at best. Even the way you phrase the question, what does the entrepreneur give up? It's not clear to me that the entrepreneur has given anything up at the end of the day when they have $1 million in the bank and have 33% less shares of their company. It's arguable that the net has improved, but the whole notion of valuation I find somewhat difficult. The broader question is, how do you structure a deal so that when the entrepreneur wins, so that it's fair, that everyone wins and everyone feels like they were treated fairly. And that's really the target that we shoot for. And the complicated terms, which I imagine we might discuss a little bit about, are really ways of just ensuring that when certain things happen, there's a roadmap for how people are treated so that everyone feels like they were treated fairly.
One of the early questions that entrepreneurs ask me, and this is surprisingly enough tied in, that I ask entrepreneurs is, what's your exit strategy? And why do I care? Well, there are an amazing number of entrepreneurs out there that think that someday they're going to pay me back for my investment. And that's not how it works. I'm buying equity. So what I tell entrepreneurs is, I exit when you exit. When you sell your shares or your shares become liquid, I expect my shares to become liquid, and that will give me an opportunity to exit, because we are investors, not bankers, and we intend at some point in the visible future to exit and take a return on this investment. And I've seen that return in 18 months and 15 years. So, it's a pretty broad horizon, especially compared to venture capitalists. But this is all tied in as to at what price we're going to invest and how much of the company we're going to end up with, and how and when we're going to exit.
All right, Bill, I'm going to keep you talking for a minute here. I've learned something that basically you told me, which is that venture capitalists would prefer that angels invest in convertible debt and let them set the valuation at a subsequent round. Tell everybody first what is convertible debt, but then explain why this doesn't work from an angel point of view. What often happens is the angel investors and the entrepreneur cannot agree on a valuation. And this is a very touchy situation, because
we're supposed to be partners, and we're supposed to be active investors. So, we're going to have this knockdown, drag-out fight over how much of the company we get for our $300,000, and then the day after closing, we're supposed to be all gushy and friendly and go help each other build a company. So it's a really tough problem of negotiating valuation and maintaining amicable terms between investors and entrepreneurs. So one dumb solution that some folks came up with was, okay, well, don't negotiate a valuation. Just why don't you invest in debt, Mr. Angel, and we'll give you, when we get our VC financing coming in later, we'll give you a 30% discount off of that next round, which means that we get, at the time the next round comes in, we get 30% more stock for our dollar when it's converted to equity than the venture capitalist does who is investing at that point in time. So we're just postponing negotiating a valuation. The problem is that entrepreneurs always anticipate that next round of investment is going to come in 6 months, and maybe under that circumstance, a 30% or a 40% discount is appropriate. But what if it comes in 2 years? Shouldn't the evaluation have the value of the company probably appreciated by 2x or 3x? And so we leave most of our returns on the table if we negotiate in convertible debt. Now, there is some advantage, and some angels do like convertible debt if, let's say, there's a highly valuable patent estate. Why would they take that into account? Well, convertible debt is downside protection. If the company goes belly up, the debt holders are ahead of all shareholders, and therefore they could, if the company went belly up, could actually own the patents. Now, I've been doing this for 27 years, and I'm always rolling the dice. This is my go-to-Vegas money. So I'm never looking at the downside. I never invest and with concerns for what happens if the company's going to go belly up, because more than half of my investments do go belly up. So I'm looking for the 20 to 30x returns on investment. So I'm always betting on the equity side, and therefore, I want to get in at a low valuation at the beginning stage and not take a discount off the valuation of the next round. So, I mean, that's actually a pretty difficult concept. So if there are questions about that, maybe we ought to address them.
Let's actually keep going now, because that can really take a while, I feel like.
Sure.
Okay.
I would. My comments are, this is a complicated issue. If you ever go out to start a company and you ask your attorney how we should do our financing with our angels, your attorney will probably recommend a convertible note, meaning you take the money and it just sits there. You take $500,000 and you have $500,000 debt on the books until you do your VC round, and then that $500,000 gets added to, let's say, the $5 million the VC gives you, and you issue shares. That's the way it works, as simply put. And your attorney will recommend it because it does avoid some of the issues that Bill just talked about. And the fact of the matter is, in some ways, it kind of is a good deal for the entrepreneur in a short-sighted kind of way. And if you're raising money, and in some very legitimate ways, if you're raising money, let's say you're from your friends or family, and you want to give them, you just don't want to have the negotiation, and they don't really care what the valuation is anyway. They're investing in you, and they would invest in you at 20 million pre or at 2. They just don't care. That's probably a perfectly appropriate approach. But if you're investing with a professional angel, my main objection is that the alignments are all wrong. And as entrepreneurs building your business, the advice I would always give you is, in every deal, whether it's a business deal with a partner or an employment contract with an employee, or your investing terms with your investors, it's make sure your interests are always aligned. And the fundamental feature of a convertible note is that, as a note holder, I want your conversion to occur as low a valuation as possible, and you want it to be as high as possible. So now our vectors are pointing in opposite directions. Whereas if I own equity, I want your next round to be at the highest possible price, and so do you, and they're pointed in the same direction. That's all the difference in the world.
Let me elaborate on something Ian just said. Friends and family money. It's actually really important that when you take money from Aunt Martha, that you talk about with Aunt Martha whether it is a grant, whether it is a loan, or whether it is equity. And most entrepreneurs don't. But let's say the company goes out of business. I can pretty much guarantee you that Aunt Martha will decide that was debt and you owe it back. On the other hand, if the company is highly successful, I can guarantee Aunt Martha will think that's equity and she owns 10% of your company. So when you're sitting down with Aunt Martha and she's coming up with that 10 grand that you're going to use to start your company, talk to her about the terms of this deal. How about Aunt Martha, we make this convertible debt. You're lending me the money and we're going to convert that into the first round when it comes, because she really won't care what the valuation is anyway.
All right, that's a really good point. Ian, can entrepreneurs who come into the band and basically start their firms, can they be the board? Can they be the chairman of the board of directors?
Oh yeah, sure. I mean, the board at the seed stage is kind of tricky. We always like to have a board seat, but the boards are not as formal as when we do the Series A. Mm-hmm. We like to put in all the rules because sometimes, just like with a note, you might think it's going to be a 6-month runway until the next round and you're going to broaden the board, and it actually turns into 3 years. So you like to have the governance mechanisms all there. So who elects the board and whatnot should all be thought through. But practically speaking, on our seed rounds, it's very collegial, and having a board seat provides a formalism. But if you ever don't have a unanimous board vote on something, you've got other problems, and the company's doomed anyway.
So, are there particular rules about how you should structure the board?
Well, it depends. Again, this really does depend. It's case specific. If it's 6 months to a VC financing, it's very different than if it's 3 years of building a company together. It depends on how much common ownership the CEO has and the founders. If you have one person having all the common, then it's much more important to have board governance so that you just can't be overruled by one person's fiat. If you have someone who is very attached to their company that you don't think may be the long-term CEO, then it's very important to lay the groundwork to be able to make a switch later if that needs to be done. And those all inform the board structure decision.
I want to add something about the chairman's job. There's a thought among most entrepreneurs that the chairman job is the power job. The chairman job is an administrative job. It's making sure the board meetings happen and that the agendas get followed and the minutes get taken care of and the fiduciary duties are taken care of. So from my perspective, even on startup boards, I like to see the most qualified person be the chairman. And that's usually somebody who's been the chairman of prior companies, can help you get all the fiduciary duties handled in advance. So I really like to talk entrepreneurs out of being the chairman and let someone who has done it before step into that job, because they have to realize, entrepreneurs need to realize that it's the CEO that is really the power job, not the chairman. The chairman is really an administrative function.
All right. And what's a redemption right? And how does that end up getting into term sheets? And just talk about redemption rights.
Redemption says that if this company is not in a position to have an exit within a certain period of time, let's say take 5 years, then the entrepreneur and the company are required to buy the investors out give them their money back, or give them money back with an interest rate, or give them their money back at a multiple of what their investment was. Does that ever happen? Of course not. But what does it do? It keeps the entrepreneur's feet to the fire. Now, and there are a lot of terms that we have to keep the entrepreneur's feet to the fire, and why is that important? Well, let's see. Ian and our groups put $1 million together and put it in your company, and maybe we get 30% of the company for that $1 million. And unless we position it carefully, you might be kicked back on Bali for until the money runs out, and there's not a damn thing we can do about it. So one of those tools that we have to keep the entrepreneur's feet to the fire is redemption rights, and there are several of those tools. That's just one of them.
Are there other ones, Ian? You want to? That's a complete answer. You're good with that? All right. So I'm sure there must be questions from the audience as well. I think this would be a good time to take them. Questions? All right. Looks like we got some up here. Let's start all the way on the right.
I'm kind of interested in your story, how you entered your entrepreneurial career, and then also
just for the benefit of the audio here. So the question is, tell us your story, both as an entrepreneur and how you got into angel investing.
Well, I'm an engineer by training. Got a couple of degrees out of the University of Illinois in materials science, back when the earth was cooling. And I worked for Fortune 1000 companies for 7 or 8 years, and decided that there was more to life than working in a research laboratory at a Fortune 1000 corporation. And I was approached by a gentleman that told me he was starting a company in an area that I knew a lot about. I'd actually done a master's degree thesis in this area. And so we joined forces, started the company, and sold the company about 12 years later to a little tiny outfit in Wilmington, Delaware by the name of DuPont. And I then served out 4 years of indentured servitude. Back in those days, when you sold your company, you actually worked for them for the amount of time that was on your contract. You didn't work for 3 months and then get bought out like happens these days. And then, so since 1980, I have been investing in early stage companies. I'll tell you why. I found that the thrill of the start and the excitement around the exit were a lot more fun to me than the operating part. I mean, I enjoyed the operating part, and I did relatively well at the operating part, but I really enjoyed the start and the finish, and I found that I can do that a lot more in angel investing than I can by being an entrepreneur. So that's why I made the shift to being an investor.
And I came out here to get a PhD at Stanford, to follow in my family's footsteps of all being professors, and I got sidetracked, really. I mean, I came out and in the early 90s, and to make ends meet, I just had to work for money at night because it's expensive in Palo Alto, and I ended up working at a startup, a medical device company where I was the only engineer, and the CEO slept underneath the folding table some nights, and that was a very different experience. I grew up in a government enclave in Virginia, so everyone worked government hours, which actually we were once in the SBA, and someone asked how many people work here, and the guy said about half. And that was really very much the attitude I grew up with, and anyway, so I love this atmosphere of just go get them, and that company did really well. It grew to 150 people, almost went public. I had a very small number of shares, but that was pretty cool at the time. And then I tried to do my own company, and I learned that small markets really make it hard to get a company funded. So though we designed a prototype and so even sold one, we never got it funded. But I did meet, at the time I was just winding that up, the two founders of Evite, who were at the time were 19 and 20, and I was 29. So they needed an old guy to help run the company, or help be their public face, and that was me. So at the very beginning of Evite, for about the first 9 months, I was even though I had a PhD in aeronautical engineering, I was the vice president of sales for Evite, and did the first couple of deals. And with that background, PhD, internet company, and a few other startups, there was this little window of opportunity when you could actually try to get into venture. So I got a job at NEA as a result, and then met Hans, who had founded the band, and viewed this as a platform, a kind of quasi-entrepreneurial platform, because what I perceived here was angel capital was a business opportunity, and Hans did too at the time. Many people thought it was still either flash in the pan or just a fad. It was here today, gone tomorrow. But here was an opportunity to build a new kind of venture model at the seed stage space. So that's how I ended up in here.
Everyone's got a different story. Okay, more questions.
I'm hoping you'll say something about the Hoffman Foundation, but my question is actually, is there some kind of self-evaluation that you can do before going in front of investors like yourselves?
Self-evaluation.
Do you mean self-evaluation? Like get a sense of how you're going to come across and all that?
Yeah, something like that. Your company specific.
I think the best thing that you can do is surround yourself with some pretty smart advisors. And, there are places that you can go and actually test your pitch before you take the big step and go present to an angel group or venture capital. But, well-practiced And well-advised is surely the answer to that question.
And my 2 cents is entrepreneurs squander 95% of the value of pitching to VCs by always trying to close the deal, even when it's a lost cause. You know, you're in there for 30 seconds, you can tell you've lost. Yeah. So instead, you just keep pushing, right? You pound them, and when they're trying to get rid of you, and they make the mistake of maybe actually giving you a little bit hint of the reason why, instead of listening and trying to facilitate them telling you more, you pound them with, well, you're wrong, and here's why. You know, you say my market's small, but look at these graphs I made. It's not small. Instead, you can learn so much whenever you pitch your idea in what kind of feedback you get. You know, the starting is, does anyone understand what you're talking about? And if they don't, well, that means you need to dumb your idea down. And so it's just, and by the way, this is the best way to pitch, which is to listen more than you talk. So the best evaluation you can ever get on your idea is every pitch should be a listening exercise.
Remember, 99% of the answers that venture capitalists will give you is maybe, and then 1% is yes, and they'll never say no because they don't want to miss a deal. So they want to be able to come back later. So if they told you no, you'll never bring it back. If they told you maybe, you get funded someplace else, you probably bring it back.
Yeah, but they'll never give you feedback either. That's the thing. They'll never give you feedback, and the reason why is no one has time to deal with the problem that entails. You know, we never give feedback at the band, formal feedback, and the reason why is very few entrepreneurs take it well. They all want to argue with you, and you might even be right, but the point is, instead of if your market size really is $1 billion and we think it's only 100 million, instead of you're thinking those guys are idiots, let me argue with them until I'm blue in the face, the message should be, boy, somehow I didn't get my message across. That's key feedback.
Okay, I know there's a question up here.
Do you generally use your angel groups to connect to the entrepreneur with individual angels, or do you treat it more like an investment club where you pool your money and divvy, you can put in a larger investment? And if it's that latter, how do you decide who gets on the board?
Well, there are two kinds of angel groups. There are funds and there are networks. We all scrub deals together, and then if it's a fund, we vote. And we say, okay, if we got a majority or super majority, we invest $300,000 in this deal. If it's a network, one guy says, I hate the deal. The next guy says, I'll put 25 in. Somebody else says, I'll put 100 in. So the networks, which Ian and I are most familiar with, although he's got a side-by-side fund, the networks are the ones where we scrub deals together and then we invest for our own accounts, whatever we want, little or a lot.
And who goes on the board is really a volunteer basis. It's not something people fight over.
But we usually try to, actually, it's less volunteer and more probing by some of the leaders of the angel group because you really want the most qualified guy to be there. And sometimes they're too busy and you tell them, no, this is really important, you got to go do it.
Okay, let's take one last question. It's just before 6 o'clock. I've seen your hand up for a while, so go ahead.
I just have a question that piggybacking off this question about criteria you look for. It's because you're early stage. Specifically, I'm interested in getting kind of a genuine answer about how much this is really about leadership of the team that's in place, personality, charisma, even like just you jiving with that person. Because it's so predictive, it's so early.
Well, I think that entrepreneurs want to tell us about one thing, the product. And we want to hear about the business. Surprisingly enough, the product is about fourth on our list of things we're interested in. And when it comes to the management team, we know we're often investing in first time. And we'd love for you to be a successful serial entrepreneur that's got 4 successes under his belt and 1 failure, except you're probably going to find your own startup company. So management team is important, but we're looking for integrity, work ethic, passion about the business, coachability. If you know everything there is to know about this company and this marketplace already, then we're probably not going to invest because you don't. So that's what we mean by management team. But the other really key issue, and Ian touched on it earlier, is scale. We can't possibly invest $1 million in a company that in 5 years will have $2 million in revenues. We've got to invest in something that's going to give us a possibility of 10 or 20 or 30x 5 to 7 years down the road. So management team and scale are big pieces of it. Intellectual property is important. I mean, do you understand what channels necessary to get to your marketplace? All of these things are key ingredients. But the two most important things we tend to look at are the management team, you as an entrepreneur, and the scalability of the company.
Yeah, I would elaborate on that answer to say, and I've been thinking about it here since you asked it, I think it all does come down to different paths to that big exit. And it really is different paths, because I can't think, when you ask, is it really just integrity and good communication and being a good listener? For some angels, it is. And others, it isn't as important. What's more important is, is this guy seem to be a genius or not? And so ultimately, I think people respond well to a proposition that suggests to them that their investment is going to be worth a whole hell of a lot in a couple of years than it is today. But the path there can be any variety of things. I'm thinking of this one woman who we invested in 2 years ago who's incredibly difficult to work with. She almost has an anger management problem, truly. But the flip side, and so the thing is, I don't want to ever call her, but she is just a bulldog, right? And you kind of invested on her because you thought she will be, she will have a nervous breakdown by the side of the river before this company fails. And I bet she succeeds by sheer force of will. Another guy, and so that's how you look past a lot of flaws for that. Another guy, he did the whole presentation looking at his shoes and never looked up. And we thought, there must be genius behind whatever he's
Let me add one more thing about scale.
Got to be quick.
I will be very quick. If angels make 10 investments, we hope we get our capital back out of the first 9, and we get all of our ROI out of 1. So we have to look at every deal as if it will scale to be that 20x or 30x. We can't be invested in restaurants with a 2x possibility.
All right. Okay, let's do one important thing, which is to thank our guests.
Thank you, Bill.
Yeah,
You did good.
Thank you.
And the folks who are staying for dinner, come on down. If you want to chat with these guys before they go off, come on down. Otherwise, we'll see you next time.